This is the calculator we're going to use to explain capital gains tax transactions. Of course, if you have a certificate from a trust or an investment fund showing the basic cost, proceeds or selling price and the gain or loss, then you certainly don't need a fancy calculator, as all the amounts you need are on the certificate ready for you to enter onto the ITR 12. You can simply enter and itemize these amounts on these certificates right here at the top of the screen and show base cost, proceeds, gain amounts straight from the certificates. However, you'll probably need help working out the gain amounts on other types of assets because it can get quite involved, and for that we need the CGT calculator on this screen, where we can add as many different CGT transactions as we wish for a taxpayer. Different exclusions and exemptions apply to the disposal of different types of assets. So the nice thing about this calculator is that we can simply select the different type of asset by clicking on these buttons, and all the appropriate laws will be applied. You can see that we have selected this particular asset as an other asset, as it is a second property opposed to a primary residence or a small business sale. I would urge you to click on these I for Info buttons, which will bring up text screens, very useful information. Looking at this first very simple example, we can see that we bought this house for 1 million rand and sold it for 3 million rand. So we made a profit of 2 million rand. The profit that SARS wants you to enter on the ITR 12 as code 4250 is 2 million rand. SARS will apply any community property splits, annual exclusions and inclusion rates. If I click on the summary window button down here, we will see the calculator has placed the 2 million rand profit under code 4250. The calculator has also subtracted the taxpayer's annual exclusion of 40,000 rand and worked out 40% of the 1,960,000 rand balance as being 784,000 rand. The 784,000 will be added to normal taxable income in the assessment calculation. 784,000 rand is not the tax you'll have to pay. The 784,000 is added to the rest of your taxable income, and your total taxable income is taxed as per normal tax rates. Closing the summary window, we can see that the property was bought after capital gains tax came along in 2001. So working out what SARS calls the base costs and the profit is very simple. The base cost is the purchase price and the proceeds are the sale price. The proceeds less the base cost less certain other costs is the profit or gain. You may claim acquisition costs such as registration costs, legal fees to prove ownership of the asset, etc. Improvement costs you may claim do not include maintenance expenses. If you fix the garage roof, then that is maintenance and you cannot claim it. If you built an additional garage, then that is an improvement and you can claim that. Now, what if we bought this asset for 1 million rand before capital gains tax was introduced on 1st of October 2001 and we sold it for 3 million, giving us a profit of 2 million? Remember that only the portion of the profit which applies to the period after 1st of October 2001 is subject to capital gains tax. We need a base cost value on 1st of October 2001. Fortunately, we had the asset valued at the time, and the valuation was 1.05 million on 1st of October 2001. This valuation becomes our base cost, and the profit will be 3 million rand less the 1.05 million base cost, which is 1,950,000 rand profit. What if we did not have the property valued on 1st of October 2001? Well, then we have to use what SARS calls the time apportioned base cost or TAB method to work out a deemed value or base cost on 1st of October 2001. Using the formulas in paragraph 30 of the 8th schedule to work out the time apportioned base cost can be very difficult, but the program works everything out for you. Let's get rid of the valuation amount and ask the calculator to work out the deemed valuation on 1st of October 2001. This deemed value becomes our new base cost, and so we have a new gain amount. The program proportions the profit between the number of years of ownership before the valuation date and after the valuation date. How did it do that? Well, it's a bit simpler than it may seem. You have to work out the total period of ownership of the asset and then proportion the profit over the whole period of ownership by the period before the 1st of October 2001 and the period after that. You count the number of years before the valuation date and after the valuation date. But remember that part of a year, even one day, counts as a full year. From 9th of September 2001 to 1st of October 2001 is counted as 1 year. From 1st of October 2001 to the 7th of July 2020 is counted as 19 years. 1 year before valuation date plus 19 years after valuation date makes 20 years. If we divide the 2 million profit by 20, we get 100,000 Rand profit per year. Add 100,000 Rand for each year of ownership before 1st of October 2001 to the purchase price to get the base cost. This means we add 100,000 Rand to the 1 million Rand purchase price and we get a calculated or deemed value base cost on 1st of October 2001 of 1.1 million. Subtract this calculated base cost from our selling price of 3 million and we get our gain of 1.9 million. Now, SARS has fine-tuned these rules a bit over the years, and factoring in expenses and costs has become a bit simpler. For example, any acquisition costs and improvements made before the valuation date are treated as if they were incurred on the date of purchase. The same sort of thing applies with sale costs. They are deemed to have taken place on the date of sale. However, if we add improvements made after the valuation date, then this does not just alter the sale price. The formulas amortize the improvements made after the valuation date over the period by effectively shifting the valuation date in the background and producing a new base cost, which means a new gain amount. If you want to use these formulas manually, then the formulas are freely available in the 8th schedule and on SARS's website in a document called Comprehensive Guide to CGT. In determining the gain amount, we've discussed the method where the base cost is known, and we've discussed the tab method. There's one final method SARS uses to determine the base cost in cases where you cannot prove when you acquired the asset or what you paid for it. If we remove the purchase date and the purchase price, then you will see that SARS uses 80% 20% method, which means that SARS uses 20% of the proceeds as the base cost. In this case, 20% of the 6 million Rand is 1.2 million. 6 million less 1.2 million base cost is 4.8 million profit, less the 2 million Rand primary residence exemption means a gain amount of 2.8 million. I want to point out that the 20% 80% rule method is very expensive, and you want to avoid having to use this method if possible.